Hello, savvy investors and finance enthusiasts. It's Iggy here from Investing Iguana, your trusted source for the most insightful investment analysis. Today, we're diving deep into an exciting topic: why ST Engineering is a must-buy, RHB's $4.45 target price explained. As an analyst with a keen eye for uncovering hidden gems in the market, I'm here to dissect RHB Bank Singapore's bullish stance on ST Engineering. We'll explore the driving factors behind their unwavering $4.45 target price and why this powerhouse in Singapore's tech and engineering sector is turning heads in the investment world. From order book successes to strategic growth segments and forecasted profit surges, join me as we unravel the layers behind this compelling investment opportunity. So, buckle up and get ready for an in-depth analysis that could redefine your investment strategy in 2024. In a notable financial review, RHB Bank Singapore's analyst Shekhar Jeswal reaffirms his confidence in Singapore Technologies Engineering, ST Engineering, maintaining a robust buy call with an unwavering target price of $4.45. This endorsement comes with a strong belief in the company's sustained growth and potential, making it a must-have in any discerning investor's portfolio. Jeswal's report, dated November 30th, casts a spotlight on ST Engineering's performance in the third quarter of FY 2023, which ended on September 30th. Despite a moderation in order wins during this period, the company's performance in the first 9 months of FY 2023 has been commendable, with a significant uptick in orders. This trend has bolstered ST Engineering's order book, offering a clear revenue visibility for nearly 3 years, a remarkable feat in the dynamic world of engineering and technology. The analyst underscores ST Engineering's potential for a 19% profit compound annual growth rate, CAGR, from FY 2022 to FY 2025, coupled with reliable yields. This projection is anchored by the strength in the company's commercial aerospace (CA) segment. The segment is poised for growth, driven by improving maintenance, repair, and overhaul (MRO) earnings as global aviation traffic rebounds, along with better margins in its passenger-to-freighter (PTF) conversion business. Furthermore, the Urban Solutions and Satellite Communications (USS) segment is expected to see gains following a right-sizing exercise and earnings contribution from the TransCore acquisition. The Defense and Public Security (DPS) business, too, is projected to contribute positively to earnings, with gradual order book delivery. Specifically, the CA, USS, and DPS segments are anticipated to deliver 18%, 63%, and 8% earnings before interest and taxes, EBIT, CAGR, respectively, through FY 2025. In terms of financial health, ST Engineering anticipates a borrowing cost of a low 3% for FY 2023 and a mid 3% for FY 2024, aligning with Jeswal's expectations. The analyst also notes the potential for interest rate cuts in the second half of FY 2024 in the U.S., which could present upside risks to ST Engineering's FY 2025 earnings through reduced borrowing costs, assuming a soft landing engineered by the U.S. Federal Reserve. ST Engineering's robust ability to generate significant positive free cash flow and the prospective sale of aircraft assets in 4Q FY 2023 are seen as strategic moves to reduce debt levels. With a formidable order book of $27.5 billion providing nearly 3 years of revenue visibility and a consistent dividend payout of 4 cents per share each quarter, ST Engineering is well-positioned for sustained dividend per share, DPS, of 16 cents for the full year. While the prospects appear bright, Jeswal also flags potential risks including a slower revival of the commercial aerospace sector, lower-than-expected contributions from acquisitions, and delays in the implementation of Singapore's Smart Nation initiative. Nonetheless, the overall outlook for ST Engineering remains optimistic, reflecting the company's strategic positioning and growth trajectory in the dynamic landscape of Singapore's technology and engineering sectors. Let's now analyze ST Engineering to see how the stock will fare in 2024. 1. Implications of the strong order book. ST Engineering, a global technology, defense, and engineering group, has an impressive order book valued at $27.5 billion. This substantial order book is equivalent to nearly 3 years of revenue visibility, which is a significant factor in the company's financial stability. The order book serves as a comprehensive record of confirmed orders that the company has yet to fulfill. It represents a steady stream of income and projects for ST Engineering. This is particularly important as it provides a buffer against market fluctuations, ensuring that the company has a consistent workload and revenue stream, even in times of economic uncertainty. For investors, this extensive order book can translate into a sense of security and predictability in earnings. In the dynamic and often unpredictable market of 2024, this is a valuable asset. Investors can have confidence in the company's ability to generate consistent revenue over the next few years, regardless of market conditions. 2. Growth in key business segments. ST Engineering's growth trajectory is bolstered by 2 key segments, the Commercial Aerospace (CA) segment and the Urban Solutions and Satellite Communications (USS) segment. The CA segment is poised to benefit significantly from the recovering aviation sector. As global travel restrictions ease and air travel demand rebounds, the CA segment is expected to see a surge in business. This includes maintenance, repair, and overhaul services for aircraft, which are likely to increase as airlines ramp up operations. The recovery of the aviation sector can thus directly contribute to the growth of ST Engineering's CA segment. On the other hand, the USS segment is anticipated to see improvements following strategic exercises and acquisitions. These could include partnerships, collaborations, or the acquisition of companies that can enhance ST Engineering's capabilities in urban solutions and satellite communications. The growth in this segment is driven by the increasing demand for smart city solutions and advanced satellite communication technologies. The growth of these 2 segments can significantly fuel ST Engineering's overall financial health. Their success can lead to increased revenue and profitability for the company, contributing to a positive stock performance. Investors can therefore expect a potential appreciation in ST Engineering stock value, making it an attractive investment option. 3. Dividend prospects. ST Engineering has a commendable track record of paying consistent dividends to its shareholders, making it an appealing choice for investors seeking regular income. The company is expected to maintain a full-year dividend per share, DPS, of 16 cents, which is a testament to its strong financial performance and commitment to shareholder returns. In the investment world, dividends are a way for companies to distribute a portion of their earnings back to their shareholders. A consistent dividend payout is often seen as a sign of a company's financial health and stability. It indicates that the company is generating enough profits to share with its shareholders, while also retaining enough for reinvestment or debt repayment. For ST Engineering, the ability to sustain this level of dividend payout in 2024 will be a crucial factor in attracting and retaining investors. It demonstrates the company's resilience and ability to generate steady cash flows, even in a dynamic market environment. Moreover, the potential to increase the dividend payout in the future can further enhance ST Engineering's attractiveness as an investment. An increase in dividends often signals confidence in the company's future earnings growth. Therefore, dividend-seeking investors may find ST Engineering's consistent and potentially growing dividends a compelling reason to invest in the company. 4. Macroeconomic factors and interest rates. The broader economic environment, particularly interest rates, is indeed a significant factor that can impact ST Engineering's financial performance and stock value. The role of the U.S. Federal Reserve in this context is crucial. If the U.S. Federal Reserve successfully manages a soft landing, a scenario where the economy slows down without entering a recession and interest rates start to decline in the second half of 2024, as suggested by RHB, this could have positive implications for ST Engineering. Lower interest rates can stimulate economic activity by making borrowing cheaper. This can lead to increased spending in sectors like defense and engineering, potentially leading to more contracts for ST Engineering. Furthermore, lower interest rates can make dividend-paying stocks like ST Engineering more attractive to investors as the returns on bonds and other fixed-income investments decrease. Therefore, a decline in interest rates could pose upside risks to ST Engineering's earnings. This means that the company's profits could potentially exceed expectations, which would likely benefit the stock. Investors, seeing the potential for higher-than-expected returns, might be more inclined to invest in ST Engineering, driving up the stock price. However, it's important to note that this is a potential scenario. The actual impact would depend on a variety of factors, including how the company manages these economic changes and how the rest of the market responds. As always, investing in the stock market carries risk, and it's important for investors to do their own research and consider their own risk tolerance. 5. Risks and challenges. While the future prospects for ST Engineering appear promising, it's important to acknowledge that risks and uncertainties remain. These include pace of recovery in the commercial aerospace sector. The commercial aerospace sector is gradually recovering from the impacts of the global pandemic. However, the speed and extent of this recovery are uncertain and can significantly influence ST Engineering's performance. A slower-than-expected recovery could potentially affect the company's revenues and profitability. Impact of global economic trends. Global economic trends, such as fluctuations in interest rates, inflation, and geopolitical events, can have a substantial impact on ST Engineering's business. These factors can affect the company's costs, demand for its products and services, and overall financial performance. Potential delays in project implementations. ST Engineering's projects could potentially face delays due to various reasons, including supply chain disruptions, regulatory hurdles, or technical challenges. Such delays could impact the company's revenues and earnings. Investors should closely monitor how ST Engineering navigates these challenges. The company's ability to effectively manage these risks and uncertainties will be crucial in determining its future success and the potential returns for its investors. As always, it's important for investors to conduct their own due diligence and consider their risk tolerance when making investment decisions. And that's a wrap on our deep dive into ST Engineering, exploring why RHB Bank Singapore pegs it as a stellar investment opportunity. We've journeyed through the key elements contributing to its robust $4.45 target price, from its impressive order wins to the promising growth in its diverse business segments. As we've seen, ST Engineering isn't just riding the wave of current market trends, it's actively shaping the future of Singapore's tech and engineering landscape. This analysis isn't just about understanding a stock, it's about recognizing the potential of a company poised to make significant strides in the global market. Remember, in the realm of investing, knowledge is power. Stay informed, think strategically, and keep an eye on dynamic opportunities like ST Engineering. This is Iggy from Investing Iguana, signing off. Stay tuned for more in-depth analyses and expert insights to help you navigate the ever-evolving world of finance.